Hey everybody, welcome to Mike Norman Economics. I am Mike Norman, your host. Well, in this video, I'm going to do more of a market call as opposed to an economics lesson, which is what I ordinarily do. And the reason why I wanted to do this market call was, well, for a number of reasons actually, but I've been reading so much recently, so much commentary talking about and forecasting a tremendous coming fall in the US dollar. Now I find this very curious, this forecast, because from 2002 until last year actually the dollar did have a very significant decline. But many people again now are predicting that the dollar is going to fall very sharply, and the basis of that view, well, there's several things, but most of it has to do, the arguments are about massive economic stimulus in the United States and the Fed printing money and all these sorts of things, which are totally really inapplicable to the dollar argument for reasons that I've gone over in many of my videos. But these reasons, these arguments are welling up again. And there are all these forecasts. As a matter of fact, the other day I read a commentary from Bill Gross, who is the chairman of PIMCO, the huge bond fund manager, who basically says, well, you better sell your dollars now before all this rest of the central banks in the world start selling theirs. Well, Bill is a wonderful marketer. I'm not so certain how good he is as a market forecaster. In some of his commentaries, he even fails to understand the distinction between a sovereign currency issuing nation like the United States, which spends by merely crediting bank accounts, and that of, let's say, an individual or a family or a business or even a state within the United States that really is constrained in its ability to spend. But I digress a little bit on this point. I want to talk about my dollar outlook and why I think the dollar is really set, not for a big decline, but for a tremendous rally. And one of the things we've been seeing now in terms of major macroeconomic policy, and it's going on now between the United States and China, is this very intense push here in the United States on the Chinese, this pressure on the Chinese to fundamentally change their economy. Not a day goes by when we don't hear U.S. policymakers saying, look, China can no longer depend on growing its way to prosperity via exports to the United States. It has to stimulate and it has to boost its own domestic consumption. And by the way, China, our policymakers are saying, you have to reduce, you have to work hard to reduce these so-called imbalances. And when they talk about imbalances, they're referring to the huge trade surplus that China has with the United States. Our policymakers don't seem to believe that they view that as some kind of a negative. Again, they're out of paradigm and they don't see that imports are a benefit, exports are a cost. We are the ones that have been living at a higher standard of living relative to the Chinese, but that's all going to change now. The quickest and easiest way for China to reduce their trade surplus, the so-called imbalances with the United States, is to exchange their dollar holdings for goods and services right here in the United States. And basically, that's what China is going to be doing. Now, this is not bearish for the dollar. In fact, this is, at worst case, this is exchange rate neutral, because all they're doing, it's like redeeming a coupon you have at a local store. You come in with your coupon and you get to redeem it for some product, something that is sold in the store. That's what China is going to do. They will be redeeming their coupons, their US dollars, for goods and services here in the United States. That will reduce their trade surplus, and it will that will reduce their trade surplus. It will decrease our trade deficit. And as a result of this, what we will see over time is that the global float, for lack of a better word, of US dollars outside the United States will start to shrink. Now remember, the United States for a long time has been the global engine of growth, and the dollar has been the reserve currency, and by definition, the only way that the dollar can be, or any currency can be a reserve currency, is if the nation whose currency is the reserve currency runs trade deficits, because only via deficits can they supply the rest of the world with the currency that the rest of the world demands to hold. That's all changing now. Our policymakers are saying, well, we don't want that anymore. We want to be like China, and we want China to be like us. They're not coming out and saying it that way. I don't think they even understand what they're trying to do. But the policies being put in place are going to cause this to happen. So long story short, rather than being bearish on the dollar and selling it, I happen to be buying it. I'm shorting Swiss francs, I'm shorting euros, I'm shorting Japanese yen, because over time, as a result of these policies, the global float of dollars outside the United States, well, that's going to shrink. And so is the U.S. trade deficit, and those things will be construed as bullish. And as Americans, we can all rejoice then that we have a strong currency. However, we will have lost a tremendous amount of our standard of living as we hand it over to the Chinese. Well, that's it for now. This is, I guess you can call it my forecast for the U.S. dollar. As always, looking forward to your comments. That's it for now. This is Mike Norman. See you next time. Bye.